From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, May 14th. You're listening to the Macrocast. Tony Fratto, New York. John Fagan, Brendan Walsh, Markets Policy Partners in the DC metro area. And our friend John Dick with Civic Science back with us with we have the Economic Sentiment Index this week. We're going to get into that. Just what do people think? I can't think of a better time to think about what do people think when we have this now raging debate. I mean, usually you have this raging debate of inflation that was, confined to market participants and Fed watchers. And now it's sort of exploded into the broader population where we're seeing discussions about inflation. We got some price news this week that indicated that prices are moving at a pretty good clip, as was anticipated, maybe not the magnitude that was anticipated. But John, what do people think about not just inflation? How are they feeling right now about the economy, job prospects, their position in where we are now with emerging from COVID?
Yeah, I mean, if we peel it back, first of all, great to see you and great to be back with you this morning. If we peel it back a bit to just sort of look at the Economic Sentiment Index numbers that we published this week, there's just really a bunch of unprecedented things about it. One of which is just quite simply, as long as we've been doing this, Tony, which is coming on a decade, I think.
Amazing.
All the five key metrics that we track: jobs, housing, personal finances, major purchases, and just outlook for the U.S. economy. Those five lines on a chart all sort of always kind of flowed a little bit in concert with one another. The general shape of those lines on a time trend have been pretty, one might lead or lag another, but typically the shape is consistent. What's happened in the last month and a half, we've never really seen here before, which is two lines going in very steep opposite directions. Number one is our people's views of the question we ask is it a good or bad time to buy a home? And that number has been plummeting. Because when you ask the consumer, is it a good time to buy a home? Their perception is, hell no, it's not, because houses are super expensive right now. And as soon as I try to buy a house, there's, somebody's paying over the list price for it. So that's sort of one psychological take on it. But the other line, which is maybe the more important one, which is the question about, do you think it's a good or bad time to get a job? Or what's your view of the job market over the next 6 months? That line is skyrocketing up and to the right. The perception of the job market is that it's just blazing hot right now. Right now, that discounts sort of this perception of, or the reality, I guess, of people maybe not going back to work in certain service jobs or what have you. But the broader U.S. population's view is that the job market is just rocking. So we've got these two lines going in really opposite
John, just
direction.
to clarify, you asked in the next 6 months, right?
Correct. Well, yeah. Do you think it's going to be a good? Yeah. Right. Well, your basic optimism for the job market.
I'm going to not go back today, but come September, I'm ready to go.
Yeah. And maybe that's why some people aren't in any hurry, because they're like, look, this job market's going to be booming for a long time. So why don't I, maybe I'll just take the summer to not work. And, I'm that's conjecture on my part, but that could certainly be one of the reasons, But yeah, to have two metrics in this index going in just diametrically different directions is not something we've seen in a decade.
No, and your take on it earlier about the fact that they tend to with a lag but follow each other makes perfect sense, right? Because if you feel good about the opportunity to get a job, you generally do feel good about the opportunity to go buy big things like cars and houses, and so you could see how they would follow. So that's to say it's a pretty strange time in the economy right now.
No doubt. But then, so let's bring it back to the discussion about, inflation, which I don't pretend to be an expert on it from a finance standpoint. So
everyone's an expert on inflation.
Well, that's the problem though, right? That hits the nail, not the problem, it's the reality.
Yeah.
The term inflation with a small I is one that the layperson consumer thinks they understand. And they simply equate it to prices are going up. Prices of things I buy are more expensive than they were last month, right? And They also believe that the idea of an inflation is inherently bad because I'm spending more money than I was a month ago. And so the perception of it among consumers, we ask, one of the things we track outside of the economic sentiment index is essentially how concerned are you about inflation on the impact and its impact on your household income or household expenses. It jumped from like 45% of people who said they were very concerned a month ago to 55% who say they're very concerned this month. And that's a number that's generally been fairly steady. To jump 10 percentage points in 30 days is a big deal.
Remind me if you do both very and somewhat, do you combine those? Or do you
when we do, 90% of consumers are now very or somewhat concerned about inflation. Only 10% of Americans are saying, no, I'm not concerned about it at all. Right. So that's where and that's up from like 70% a month ago. So, yeah, I mean, true or not, important or not, bad or not, the consumer is sensing, feeling this or reading about it in a way that is, pretty profound, at least from just looking at the numbers.
Yeah, true or not, I would say it's obviously true, right? I mean, these measures are real. They're not just their sentiment is reflecting what they're seeing, but there's always confusion on inflation. There's, if we, what we commonly think about inflation is, the things that we buy get more expensive, but people have a skewed view on what they buy. In fact, some of that goes back to, I even remember going back to my earliest, books on learning about inflation. You always talk about the household basket, or your shopping basket, and we still talk about the basket, right? But the basket leads you to think it's like that when you walk in through the supermarket, those things that you put in the basket, that's the cost. And while that's a component of the cost, we spend money on lots of other things. And we're also extra sensitive to price increases. We tend to ignore price decreases, and very big things in the economy over the years have continued year after year after year to get less and less expensive. And, we could do a whole show just unpacking what the thing is, right? But just as an example, the cost of a gigabyte of, storage, right, is like free, right? It's free. 20 years ago, it wasn't free. 20 years ago, you couldn't buy it at any price, unless you were a institution, right? So now we have these things that we can, so we bought these, we could carry them around on our, not even in our pocket, but on our iPhone, or on our iWatches. So those things have gotten less expensive. That's extrapolated throughout the whole economy. Inflation is, just for the record keeping on this, is sustained aggregate net increases in prices, not in any acute increases in any one product or even set of products. And because of the things that some of the things that we pay attention to most frequently, fuel and food, those are things that we actually pull out of our measures of inflation because they're too volatile. They go up and down quite a bit seasonally and otherwise. And so we actually talk about core inflation, which is all the other things that people are most sensitive to. So we're not even paying attention very much to the things that most consumers are most sensitive about.
And that perception really is so key. And obviously, when you have the Colonial Pipeline shutdown, isn't because of inflation, it was a cyber attack, but the image of gasoline lines, for anybody of a certain age, it rekindles memories of the 70s and that inflationary dynamic. And that's certainly playing at the forefront of the minds of, some of our sort of senior statesmen in the economics field, and Larry Summers among them. But, the way that they measure inflation, the measurements of inflation, the Fed has done a really good job at explaining how these distortions are coming through, the kind of wonky statistical from the statistical base effect. These huge numbers are inflated because of a comparison to last year's inflationary shock.
Yeah. So John, let's talk about each of these, right? So base effect, for people who aren't like that usually diving into inflation, it's the fact that, prices of a whole lot of things went to zero
yeah,
a year ago,
or negative. Yeah.
A lot went negative.
Yeah.
So, airline tickets, theater tickets, all of those things that, the things that you go out and do, travel, entertainment, all collapsed. And so, so now if you, that's the base, if you're basing, your inflation over the past year and you're starting with April of 2020, you're going to see measured inflation increase because of those sectors.
It would be much more troubling if these prices weren't going up.
Yeah. So that's base effect. Then you have some of the other sort of transitory.
Yeah, the supply chain.
They're hopefully transitory, right? On some of the disruptions on the transition of the economy. Then you have things like the chip shortage, lumber shortage.
So used car prices accounted for 1/3 of the increase in core CPI. And it was entirely because we shut down public transportation. So people bought all the used cars and we don't have any used cars. That has nothing to do with Fed policy. In fact, raising rates because of that would exacerbate the issue because it would make it more expensive for companies to build more cars.
Yeah, it's a really interesting case. And we saw the Council of Economic Advisors in the White House put a very comprehensive tweet series of tweets. Is there a word for a series of tweets?
Tweet thread. It's a very
I'm so out of touch. The Council of Economic Advisors put out an excellent tweet thread on the subject of the distortions and pushed back very meaningfully on these numbers. And it's a really compelling case. But the difficulty is, even if we are looking through this,
but just John, just to go back, what they said is they showed the chart of where prices were. They all went down, so there's a dip in the upward trajectory, slope. And now, if you had extrapolated where prices should have been if we didn't go through a pandemic, they're basically where we are right now. So we're back to normal. The question is where we go from there. But that's what the point that the Council of Economic Advisors was saying.
John Dick, how many people are reading the Council of Economic Advisors tweet threads on?
Yeah. Well, actually, good segue, because I'm not. And while you guys were talking way over my head about all of this stuff, I was actually pulling something up, some new data we have. And it was just a hypothesis I just checked. But so our question that we're tracking, sort of fears of inflation. Guess what the single most predictive question in our database was about how concerned somebody is about inflation? Guess.
Google searches of inflation.
Party.
Yes. Political party.
Political party.
Republicans are literally 3 times more likely than Democrats to be, quote, very concerned about inflation, which, again, this is consumer data. So if anything speaks to sort of the emotional nature of this topic among the consumer population, which, by the way, doesn't make it any less real, right? Because those particularly, the question here is, rational or irrational, will it change their behavior, right? Like if I'm a retailer, that's what matters to me. And if, so basically 79% of Republicans say they're, quote, very concerned about inflation, only 27% of Democrats. And so what you're seeing there is a conflation of, I'm kind of feeling and seeing and reading about this stuff. But part of the reason I'm reading about it is because all my friends on Facebook are sharing these memes about lumber being up, and I see these same memes over and over again, right? Like it's a way for them to point and say, see, look, that's what you get for electing Joe Biden, and so that's, again, these are all just conspiring to this like frenzy that people have. And again, not to take away from, is it real, because we know prices are going up, but how people are reacting to it is heavily politically dependent. It's why.
John, back to your categories. You mentioned the jobs shooting the moon. You mentioned the time to buy a house going down. How about major purchases? Because in Japan,
it's just
kind of in the middle.
It's kind of wobbling right in the middle. And I think that's sort of kind of what we're talking about here. Look, putting inflation aside, the perception of it being real, there are other things that make people just feel a little bit uneasy about the economy right now. When you go into a restaurant and you see a sign on the door that says, please be patient with our servers because nobody's coming to work. Like people aren't used to seeing that kind of thing. And they're like, I don't know what that means. And Tony used the word transitory, which I get, but I'm not sure a lot of people understand that. Yeah, this is temporary, or right. We expected this. It is what it is. We're going to ride it out. Everything's going to be okay. I'm not sure the average consumer intellectualizes that on a day-to-day basis.
It's a great point.
A little skittish.
Because inflation is both an economic, phenomenon. Supply and demand, prices go up and down. But it's also psychological, especially as we've seen in Japan, where the Japanese have accepted deflation, and you build your life around that way. If you think prices are going to go down, you make personal choices and business choices, and then it makes it difficult to break out of that deflationary environment.
Yeah, you tend to defer major purchases in deflation, and certainly it'll be interesting to see if people do have that. That's certainly the inflationary mindset is buy. You better buy today.
Buy now,
because prices are going up. It's a far more vibrant kind of economy.
No question. And by the way, I remember, we would go to Japan in the, one of the early decades of deflation, and have these conversations, and you talk to people, and they would talk about the virtues of deflation. This is a good thing because prices are coming down for people. And, and then you'd have people on the productive side of the economy, who understood that this is clearly a disaster, that if people are going to hoard and wait to buy things, then you've broken the economic engine for your country. And that's kind of what happened in Japan. But there was also, look, Japan was Japan is a phenomenon. We've used it as a dirty word for a long time, right? It was like this inflation that overtook Japan. It started with a big deflation in their equity bubble back in the early 90s, late 80s, and it's been with us ever since. It's very likely, in fact, I think it's pretty clear now that Japan was just on the leading edge of this great, inflation, the conquering of inflation. So we've seen it in Europe. We've seen it, less so in the United States, but to a large degree in the United States, this conquering of inflation. But the conquering of inflation has put us, dangerously close to zero, dangerously close. No, zero isn't the problem. Negative deflation is the problem for what we just talked about. It's hard to have a productive economy. Why would you invest in the production of products whose prices are going to fall?
Yeah, we're taking on debt that's going to get more expensive.
Debt that's going to get more expensive, right? Like it's just like the economy. That's why central banks have all come to the conclusion that very low but positive inflation is a generally good thing.
Right.
And that's what the Fed is trying to do right now.
Yes, that's the point. Isn't the Fed's goal for the last 10 years? They haven't been able to reach their inflation goal. They've been trying to raise our long run path of inflation. Now the market's freaked out about it, but I feel like from a policy standpoint, they view this as an opportunity.
Yeah, that was a question I got from a reporter earlier this week. When do I think that inflation will revert back to its pre-pandemic levels? And I said, well, it's important to remember that that's not what the Fed wants. Right. Status quo ante is not where they want to go. They want to reset to a higher equilibrium. And, when you look back at the history of the Powell Fed, this was a Fed that was normalizing interest rates through, the good part of his early tenure. Mm-hmm. And he was handed off from when Chair Yellen. She was the icebreaker, the path breaker on normalizing interest rates. Chair Powell took the baton and ran with it, but he only got up to barely to 2.5% is where, the policy rate topped out before they were, that was so eye-wateringly tight that it made financial markets skid off the off the road. Yeah, I think that looking back at that is for orthodox economic thinkers, that is a bad sign for your economy. And when you see an op-ed from former New York Fed President Bill Dudley saying, "Hey, buckle up because on the other side of this down the road, the Fed is trying to get to the interest rates are going to be much higher. The subtext of that is, that's what the Fed wants. They don't want
4%. Isn't that the goal? Isn't that what we want in a few years, to be back to 3.5%, 4%?
Yeah, I'd be happy with something less, below 4%. I don't think we need to get back. I think this idea of getting back to something in the 4% range doesn't reflect a new normal, but 3.
Yeah, exactly.
But
we're not talking about 10. We're talking about back to a normal weight. So like a mortgage isn't free.
Like a cost of capital that like people would recognize. And then, if you have to cut interest rates, 400 to 500 basis points in a recession,
you get some bang for it.
Off, to do the needed accommodation, if you're topping out at 2.5%, well, then, you're in quantitative easing territory. It's easy to see why the Fed wants to look back at what it did post-global financial crisis, learn from what it sees in hindsight as missteps or mistakes, and try to juice this baby into a higher gear on an economic and inflationary level.
Let's take a break here. I want to come back and get back with John Dick, talking a little bit about sort of what this means for how people are going to think about things, and it has consequences for them. It has consequences for the political economy around additional spending. Obviously, it also has consequences for how people think about what their government is trying to do to them. So let's take a break. You're listening to the Macrocast. We'll be right back.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The Civic Science Economic Sentiment Index, powered by HPS, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through HamiltonPlaceStrategies.com.
All right, we're back on the Macrocast. John Dick, so the way people feel, whatever as we've said, whatever is reality with inflation, people feel like it's a concern, maybe a partisan, tribal thing, but I think it's even I think it's elevated even on the Democratic Independent side, also, even if it's not at the heights of where it is with Republicans. So people are generally more concerned about it. And at the same time, you have arguments out there that you have the Biden administration proposing trillions of dollars of additional spending on things, by the way, that people are generally positive about. These are popular proposals for infrastructure and care, even if people are frightened by the price tag of it. But do you see possible consequences for this of people making it harder for Congress and the White House to get agreement on these things at the price tags if people perceive spending as more creating more inflation?
Look, I mean, that's a lot for me to sort of unpack. But what I would say
to solve all of this.
Because I think there's a bunch of different things at play here, psychological and otherwise. But first of all, I mean, you're right. 78% of Democrats are still at least somewhat concerned about inflation. So it's just sort of the extremeness with which Republicans are more concerned than Democrats. So, this is a front of mind. People are actually noticing it on their grocery bills, right? That's where it sort of hits home first. So let's just start there and say that. The reason I get a little cynical trying to answer a question like what effect it will have on policy is I wish it would, not because I have a particular view about that spending or not, but because it would tell me that the voter is basing their opinion on something other than tribalism, right? Like, unfortunately, like the world we live in today it's kind of like, well, whatever my team is for, that's what I'm going to be for, instead of like sitting and thinking like honestly and objectively about what's best or worst for them. I don't know if the average consumer connects their fears of inflation to more government spending on infrastructure. I don't think that the average consumer makes that connection at all. Right. Most of us in the layperson community, of which I am one, don't necessarily understand what causes all of these kinds of things. And it's just easier for us to either blame or laud whoever is in power for it just happening while it was on their watch, right? But in terms of like trying to explain the intricacies of these things, I don't think the average consumer does that. So I don't know if it will have a direct implication or impact on how the consumer feels about those kinds of policy initiatives. Now, if the economy and household income starts to decline, or household cash starts to decline, and people become just overall less positive about the president, it may weaken his ability to do those kinds of things. I'm just not sure that the consumer draws the direct line between inflation and these policies. I wish they could, but I don't think they do.
John and Brendan, what about markets?
Yeah, I think that there was a sense before the American Jobs Plan was released, and the American Families Plan for that matter, that these big spending numbers would be highly disruptive potentially to the treasury markets, and that when the big 2.25 trillion, these big numbers on top of the 1.9 trillion American Rescue Plan, but that was not how it played out. They came in with when they were the treasury market had already reset. Longer dated treasury yields had popped up, but when those numbers hit the tape, they actually kind of settled down. And in TIPS break evens, the market-based gauges of inflation expectations, were settled through those announcements as well. Partially because there were pay-fors, and pretty significant pay-fors. Those pay-fors were obviously still to be debated, but also the spending numbers are to be debated. The finger in the wind is that they won't get all of what they're asking for. And then there's the kind of cadence of expenditure. When you looked at the American Rescue Plan, that was sugar high, right? That is going right.
It's largely all been spent, distributed and spent already.
That was going right into the veins of the economy, right? The American Jobs Plan, to the extent that it gets through, is going to be offset by pay-fors, and it is going to be on a much longer term schedule of payments. And everybody knows the complexities of infrastructure and getting that money out the door. And the American Families Plan is behind that in line. And we've talked in previous discussions and in previous podcasts about how that may end up being something that doesn't get through Congress and the Democrats end up running on in the midterms. So I think that the broad story that these big fiscal packages are going to overheat the economy has come off the boil to some extent in the markets, but there's still a lot of sensitivity just broadly about the sort of background radiation of inflation that we see every day, whether it's the gas lines, whether it's elevated lumber prices. But the Fed's really made a credible case, and we saw a one-day kind of freak out in the markets on the CPI. That was pretty nuanced market reaction, to be honest. And then things have settled back down. So it's not clear that this has really taken hold in the markets as a huge as a huge headwind to risk appetite.
Tony, when we talk to retailers and sort of the consumer companies that we work with, I will say that any advice we give them or context we give them around the data we share with them is to think about these things on a relatively short-term basis as it relates to the consumer and consumer spending, because I do trust everything you're saying, that not only were these things like predicted, they were almost desirable, and that there will be sort of, green pastures on the other side of them. When we talk when these retailers want to know, is this going to affect back to school spending in 3 months, right? Yeah. We just saw, retail spending was essentially flat from March to April after being way up in March. That's probably because March was artificially high for a lot of reasons we can all pretty easily explain, right? So don't overreact to that. And again, that's where these kind of like short-term inflationary fears only really matter, in my opinion, if they create irrational changes in spending behavior by consumers in the short term, which, it probably won't affect summer travel because a lot of that's already been booked and planned. But could it start to creep in, late summer when we're talking about buying apparel for kids, like maybe I'm not going to spend as much because I'm afraid of these wheels falling off. But I think there's also enough time over the next, say, 60 to 90 days before back to school hits its full thrust for people to realize, like, okay, calm down. It's really not all that bad. But it's a fascinating thing to watch right now.
It really is. I mean, it is, the thing, if you get further than that near term, right, the concern that people have is that despite the fact that the Fed, Chairman Powell, has tried to say over and over and over and over again that he's going to look through this transitory inflation and keep rates low and let us run, hot, is that his concern is that if he does try to deal with squelching inflation in the near term, he's going to choke off the kind of growth that's going to allow people to actually, go back to those jobs. And so, if history is a guide, he's got very good reason to believe that. Every time the Fed has tried to, engineer a slowdown, it's ended in maybe a mild recession, but a recession. And who gets hurt in the recessions? The lower quintile of workers. So it is. We have this interesting situation where the Fed is trying to tolerate higher inflation to ensure that the power of this economy can get to those lower quintiles of the economy. At the same time, those lower quintiles feel like they're being most hurt by elevated prices.
Yeah, I look. It's a different ballgame if we're having this same conversation a month before Black Friday. Right, because that's when irrational spending behavior changes could have a super. I mean, back to school is important, but it's a fraction of the importance of what holiday retail is going to be. And lots going to change between now and then, right? A lot of the unemployment benefits are going to have phased out by then. We're just going to be in a different place in that lower quintile, as you put it, of like the job market. So I think it's just a little bit of sit and wait right now, and don't overreact to the news of the day right now, particularly when you can see that a lot of people are reacting or overreacting because of their political dispositions, right? That I think that delegitimizes some of the fear in a little bit, right?
If only we could see the future of what October is going to look like, October 2021. If we could all quit our jobs if we knew what October 2021 exactly what that was going to look like, but. It'll be interesting to see. John Dick, John Fagan, Brendan. We haven't had a sort of a one subject show ever. I think on the Macrocast it was the first for us, but I think this was
certainly not one when I was here. That's for sure.
I'm glad you were here for it because it's of all the things we talk about, it's the one that most tangibly impacts people and how they think about things. So great to have you here, John. John, we have a big weekend. Pens Islanders. Let's go Pens. I'll talk to you soon. John Fagan, Brendan Walsh. Good luck with your teams as well.
Yep, Saturday. Caps.
Good luck. I hope you guys beat each other up.
That's a given.
Good. Have a great weekend. We'll see you next week on the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.